This week, we're going to have a look at the latest market moves in response to a potential peace deal between the US and Iran. We'll give a review of our latest Global Investment Strategy Group meeting. We'll also have a look at some key data coming out of China and a review of the SA GDP print. We're going to start off with the potential peace deal between the US and Iran. It's been widely reported that a deal is expected to be signed on Friday. And in the interim, we've seen a pretty sizable response in markets. If you look at the S&P 500 future as an example, at the time of recording, that's up just over 1%. The Nikkei future at the time of recording is up just over 5%. And we've seen oil come down quite strongly too. Over the past month, there has been some indication in markets that a peace deal was being anticipated. And as a result, once incorporating the latest move, you'll see that Brent over the past month is down around 20% or so, which is clearly very helpful for the inflation outlook. And I would just add to that as well, we've seen a quite sizable decline in grain prices too. Corn, as an example, down around 10% over the past month. And the net result of this is, should a peace deal actually stick, and we do see these prices settling at these levels or maybe even levels slightly lower, the inflation trajectory globally has changed quite materially. And we will incorporate these numbers into our inflation forecast over the coming weeks. Let's see where they settle. But in the interim, the inflation numbers, which we're going to talk about in a couple of slides' time, is going to be very much backward looking, and the outlook has likely shifted quite meaningfully. That takes us to our Global Investment Strategy Group. Last week, our GIST committee met, and this is a committee populated by investment professionals in our UK, Switzerland, and SA offices. And the purpose of this committee is to come up with a view on global risk. Should we be risk on or risk off? And there's a score that comes out of that committee ranging from -3, which would be very bearish, to +3, which would be very bullish. And at the moment, that committee is sitting at 0, i.e. neutral. And in very brief summary, there are a couple of moving parts. One is that we're seeing increasing evidence that the US economy is improving. There's a range of hard data estimates we look at, which have recently picked up. We spoke last week about the non-farm payrolls numbers as an example. But at the same time, we've got very stretched valuation. And so it is largely in the price. And the key question for us is, how long can margins remain high in the US? How long can ROE, return on equity, be so persistently high, given the strong link with valuation? So that's the thinking in a nutshell. I'm just going to run through a couple of slides. It is important to note that the US economy at this point is still ticking along quite nicely. The current consensus forecast is that the US economy will grow this year by just over 2%. And the global economy will grow by just less than 3%. This is a pretty good set of results across the globe. And if you look at the forecast for the next couple of years, there's little sign of concern in consensus estimates, despite all the volatility that we see in the oil price and other concerns. At the moment, the consensus forecast is one of a pretty benign environment over the next couple of years. And when you tie that in with ROE that's so high, you would expect to be overweight. The concern, of course, is valuation. The US market is trading on a forward PE just a bit above 20. That's more than a 20% premium to normal. The rest of the globe is actually looking reasonably fairly priced outside of Japan. But Japan, we do have a number of reasons why we think that the multiple is justified. We've spoken about that before, and we will provide more updates on that going forward. But in the interim, I'm going to focus on the US here. It is trading at a pretty sizable premium to normal. Now, that is justified when you look at ROE. Return on equity in the US market is very high relative to history, has recently ticked up, and very high relative to the rest of the world. And we know that ROE has a very strong link with valuation. In fact, if you look at the US at the moment, it's a very neat line between all the sectors of the market between price to book and ROE. Higher ROE gives you higher price to book. So the key question, as it relates to the US, is how long will ROE remain elevated? And should we think that ROE is going to normalize over the coming few months or coming few years, that would mean that valuation would then start to come down and we would have to be much more cautiously positioned. But given the current persistence that we're seeing in margins and ROEs, particularly in the US, we think that it's likely to be the case that equities are not going to massively underperform fixed income in the US. And as a result, we're staying neutral at this point, contrasting the improving economic environment with a market that appears to have largely priced that in already. We will provide more details and written commentary, which will be sent out over the coming weeks. That takes us to inflation. We've now had inflation prints for close to 35 of the 50 largest economies across the globe. No surprise, inflation has ticked up again. Bear in mind what we said at the top of the presentation. This is backward looking at this point. Global inflation has now ticked up to 3.4% from 3.3%. What's interesting about that, though, is unlike the period post the Russian invasion of Ukraine, while inflation has picked up, it has, in the main, surprised on the downside. So we've seen inflation increase by less than had widely been expected. Inflation surprised on the downside for 52% of the countries that are reported for last month. Again, very different from that period in 2022 or so, where inflation increased and surprised on the upside. If we look at US inflation in particular, US inflation is running at 4.2%. It's not often the case that US inflation is meaningfully above global inflation. It's happened on a handful of occasions in the past 30 years. This is one of them. US inflation is running at 4.2%. Global inflation is running a shade below 3.5%. It is an unusually large gap. And there may well be some upside ahead to US inflation too. We look at a range of leading indicators for US inflation. One of them is the ISM Services Prices Paid series. That series is suggesting that US inflation in the next few months is going to get to a number just a bit above 5%. If you look at the PPI data that came out of the US last week, that suggests that US inflation is going to come out just a bit below 5%. You average it to, and those series are telling us that US inflation is likely to head to 5% in the next couple of months. Now, if Brent remains at current levels or even falls a bit further, should there be a peace deal, then what we will see is that while US inflation grinds up, subsequent to that, once those numbers start to come through in the CPI data, and it takes a couple of months, we'll see a steep fall off in US inflation. But even so, the Fed is unlikely to be comfortable at this point. And the reason for that is that while headline numbers are going up and will likely come down should energy prices remain where they are, core inflation is proving to be sticky. Core CPI inflation is sitting at 2.9%. And we look at a range of other sticky measures of inflation. And whichever one you look at, you're looking at an environment where inflation is uncomfortably high for the Fed, and this is not directly related to energy alone. There's a broad-based increase in pricing in the US, which is suggestive of inflation, which is well above target and is likely to be putting pressure on the Fed. Now, this is Warsh's first meeting as chair this week for the Fed, and we'll get some guidance around how he sees the current inflation shock and his thoughts around the balance sheet. And so we will report back on that next week. But even so, there's got to be a level of discomfort at the Fed at the moment, especially when you consider that other central banks have been hiking, like the ECB last week. Switching to China, Chinese inflation, unlike countries across the globe, is still low. It's below target, sitting just a bit above 1%. The central bank target there is 2%. And if you look at total social finance, which is a key leading indicator for the Chinese economy, that series is down 15% year on year. The 3-month average is down 15% year on year. And that suggests that China is likely to be entering into a bit of a soft patch ahead. Exports have been very strong, up close to 20% year on year. A lot of it has been AI related, but the broad Chinese experiment in trying to drive domestic demand and shift away from old school Chinese growth, which is very heavily reliant on exports, seems at this point to be gaining little traction. And in the background, there has to be some rising concern around the outlook for commodities, given that domestic consumption in China still appears to be so weak. Finally, on to South Africa, there was a GDP print for SA that came out last week, surprised on the upside. Growth in South Africa in the quarter was 0.5%, so running at a 2% annualized rate, which is pretty good. But if you scratch a little bit, a lot of that was due to agriculture. Agriculture had a great quarter, but it is a relatively small component of the SA economy, and it is pretty volatile. If you go back to pre-COVID days through to now, agricultural output in real terms, so in volume terms, is up 29%. It has been the standout sector in the SA economy. Finance is up about 13% relative to pre-COVID levels. The rest of the economy is roughly in line, if not slightly down. And then you've got construction, which is still down around about 30%. So there is still some way to go. It looks like the SA economy is ticking along now at a sort of a 2% level. To get it much higher, we're going to need to see much more investment, and we're going to need to see some of the other cyclical sectors really start to improve too. Can't simply rely on agriculture. And that's where we're going to end it for this week.